According to the monthly chart, Carvana is up nearly 1,000% since bottoming back in March at the lows of sub $10. However, if you go to the weekly chart, you can see that now price is range bound between a daily buyer's level at $36 and a daily seller's level at the $37 level. However, this past week, Carvana stock was upgraded by Wedbush, and they had a price target of $48. Now, the analyst at Wedbush cites the recently completed debt exchange and improving profitability could drive upside in Q3 2023 and Q4 2023, and also gives the company at least 2 years of breathing room to execute. However, while the stock has seen significant growth, due to the optimism around the debt exchange, consumer metrics are showing weakness. Web traffic to Carvana's website is declining, and consumer happiness scores are low compared to their peers. Now, before we continue with the analysis, let's quickly look at this video that goes into depth in terms of the happenings of the consumer.
It's time for our cash tag segment. For that, let's bring in Megan Brantley. She's the Vice President of Research at Likefolio. Welcome back to the show, Megan.
Thanks for having me, guys. Happy Monday.
Happy Monday to you. So we're talking Carvana. The stock got upgraded today. I mean, I'm taking a look at the chart, Megan, over the last 9 months. I mean, the stock's up 990%. It's something ridiculous, but the stock got down to about $4.50 at the start of the year. I mean, what kind of data do you have? Because I think the story is out there. This is a short squeeze. There's a big short open interest in here. But I guess I want from you guys is what kind of data do you have to back up the fact that, hey, this stock has rallied, but maybe there's some underlying tones. You got, an upgrade today out of Wedbush.
I know, I saw that. And, whenever you look at this, you see shares up almost 1,000%. I think a lot of this, too, was propelled with optimism about a debt exchange that essentially is buying the company more time to prove itself. But the kicker for us is we're looking at those underlying consumer metrics that are driving sales and revenue. And those metrics on our end are starting to flash red. And even last quarter, I think retail units sold were down by about 35% year over year, even though profitability was better than expected. But just on the consumer front, we're not seeing signs of a turnaround. And the first place that we look to this is just web traffic data. So visits to Carvana, and especially a digital-first site, this is our most correlated and convincing metric, and we show continued weakness. Those visits are down by about 15% year over year. But I think more concerning is the fact that Carvana is underperforming its peers. And so whenever you look at these web visits for a name like a CarMax and an AutoNation that have more of these hybrid sales experiences, they're actually showing improvement where you see a decline for Carvana. So, that's the first red flag that we look at. And then the next place we look is we look at consumer happiness, and this tends to be our best long-term indicator. And when you look at consumer happiness for Carvana, it's around 55% positive, and that's low even by our standards. And more concerning, perhaps, is that we find Carvana again in the bottom of the pack whenever we look at some peers, especially in auto sales. And a lot of consumers are talking about, they're missing some of the perks of the dealerships, the repairs, the tune-ups, just having someone to turn to and somewhere to go whenever they have a problem with the vehicle, which those problems, reported problems are rising. So I think that spells trouble as well for Carvana if consumers feel like they can't trust the platform. And so just the combined web traffic, continued decline, and the relatively low consumer happiness scores give us reason for concern whenever we look at Carvana, and especially how much it's run just this year.
Megan, I agree that the long-term views of this company are troublesome, right? They've got big debt load. They've got issues. They just refinanced a bunch of debt, but they had to dilute more shares to do that. But this stock, I mean, they're not out of business yet. right? I don't know where they're going to be, but they're not out of business yet. And this stock jumped last week on the retail sales data because it was such strong for cars. And you can make a case that a UAW strike is good for used cars. And as long as you don't look out too far on the horizon with them and they just win short term, this company's got a shot, at least, to stay in business, as long as they keep working on the debt. And, it's interesting. All these companies, CarMax, what was in there too, Megan, they all suffered during the pandemic because of the volatility with pricing. Don't they benefit from more stable pricing, buying cars and selling cars, marking them up slightly, getting volume in the door? Isn't that what's going to lead them back, if they make it back at all? I have no idea they're going to make it back, because that debt load, Megan, is a big one.
It is, and that is true. This certainly is still a viable business. However, we're looking at this too from a longer term lens and even an earnings lens, and we see a little bit more flashing red just in terms of how the consumer is engaging with them, because that's really where we're specializing here. And a lot of these macro headwinds, when you look, I think that the used vehicle market still has a hill to climb. You've got continuing, pending the UAW strike, new vehicle inventory improving, and you've got used vehicle loan rates that are still sky high. Whenever you look at the average loan rate for a new vehicle, I think that's between 5 and 14%. For a used vehicle, that's between 7 and 21%. And so we continue to see that weigh on the consumers. And then we also saw signs, I think last month, for the first time, used car prices are falling again, and that could cut into some of these profits. So I think that there are a lot of macro headwinds at play as well that Carvana may have to overcome into this next quarter. And I think that the recent run just makes expectations even higher that investors are going to start to expect these improvements and these turnarounds, especially in its underlying business model. And we just don't know if the consumer demand is there enough for us to make a bet to the upside for this name.
Yeah, they report earnings early November here, Megan. So we've still got some time. I mean, if you guys have an earnings score on something like this, what would it roughly be?
So we're in the neutral range right now for Carvana, but we're in the really low range of neutral. And I think that considering just how shares have performed near term, that sets the expectation bar a little bit too high for us to bet to the upside. In fact, we're starting to watch for, if we had to pick a play, more to the downside.
All right, great.
As I mentioned, the price finds itself in between a daily buyer's level at $36. You can see this rally, basing candles, and then a gap higher, which is a rally. So rally, base, rally. However, it gapped right into a daily seller's level at $37. As you can see here, you have a level on level. You have a drop, basing candles, and then a drop. And then this drop is the legging candle to these basing candles, and then the drop down. This level worked once back in August, has worked again in July, and again in September. Again, price is range bound. You could continue to play the range, but your reward to risk is going to be limited until we break out to the downside, sub 35, or to the upside above $70. Thanks for watching. Subscribe. Please like the video.